Dear investors, Prasenjit Paul here, the author of the best-selling book How to Avoid Loss and Earn Consistently in the Stock Market. In this video, I am going to offer you the book summary, which is a must-watch video for you because since after the publication, the book receives thousands of positive reviews among readers. And not only that, this is the highest rated book on the stock market written by any Indian author. So without wasting much of your time, let's jump into the book summary. The first chapter mentions that the stock market is surely not a place to gamble, because have you ever seen any millionaire or billionaire making consistent money through gambling, or like winning lottery tickets? One can win lottery tickets once or twice but not consistently over 10-20 years period. However, in the stock market across the world, there are many millionaires, there are many billionaires who are making consistent money through stock market investing. So surely stock market is not a place to gamble. However, on the another hand, thousands of, in fact millions of retail small investors are losing money in the same market. To avoid loss in the stock market, you must have to know the reasons why investors lose money. So in the first chapter, with an example, I have mentioned multiple real life scenarios, multiple cases where investors lose money in stock market. Mostly investors lose money in any form of trading, be it short-term trading, intraday trading, or in futures and options. All investors also lose money in long-term investing, but in lesser proportion. See, successful trading requires full day dedication, and that's a very mentally exhausting process. So if you are involved in any another full-time profession or any job or any business, then it's virtually impossible to make money consistently in trading using some kind of tips or doing it as a part-time. So successful trading requires full-time dedication, and that's a very mentally exhausting, tiring process. Sometimes I have noticed that many persons also lose their night sleep due to multiple kind of positions in the trade. However, if you are also involved in another profession, you can still make money consistently and avoid loss in the stock market through long-term investing by selecting fundamentally strong stock and holding it an appropriate period. The next chapter mentions from where to start your research. See, for any company in the financial statement, there are hundreds of ratios and figures. The question is where to start, which one to give highest priority. You might be surprised to know that you shouldn't give highest priority on profit and sales growth numbers, because this profit and sales growth numbers are easily manipulated and can be easily altered. Multiple companies do fraud just by manipulating sales and fraud, and even many big companies also do alteration of sales and profit just because of the accounting norms. I'll give you an example. See, suppose I am a customer and I have placed an order just worth rupees 10,000 for a big firm. Now, the big firm issues invoice and they record sales even much before my payment or much before the order delivery. So although the sales is recorded worth rupees 10,000, but still I didn't actually pay it to the company. I will pay after receiving product and after taking some time. So now let's say, for example, after some period, due to any reason, maybe due to my financial inability or due to any kind of issue in the product or any business deterioration, I won't unable to pay that amount, or even maybe I am a fraud because I can't able to pay that amount. So what happens, although the 10,000 rupees sales recorded in the profit and loss statement much earlier, but on later date the payment or the cash payment didn't receive at all. So in such case, what happens, it affects the cash flow statement and the balance sheet of the company. Many companies do fraud just by inflating sales and profit numbers, and these alterations are always there for any kind of firm. So the question is, if it is not the profit and sales growth numbers, so where you should look first? What should be your first priority? The first priority should be on the return on equity and debt to equity ratio. These are the two balance sheet figures. Just by looking at these two figures, return on equity and debt to equity, you can tell, anyone can tell the fundamental strength of any company. How? For that, you must have to read the book. The next chapter talks about the easiest way to judge management quality. See, for any retail small investors, it's not possible to visit the factory, to visit the company office, meet management, and then invest in the stocks. It's not possible. However, in this chapter, just from the comfort of your home, using some very simple data, how you can judge the quality of management. In this process, I have used just 3 parameters. First is the shareholding pattern, second is the tax rate, and third is the return on equity. Just by looking at the shareholding pattern and the promoter holding, pledged shareholding, and the trend of institutional shareholders and public shareholders, a lot can reveal about the company management. Same with the tax rate and return on equity. See, all these 3 figures are very easily available. You don't have to visit anywhere, just an internet connection and just few clicks are required to get all these figures. So from the comfort of your home, you can easily conclude the management quality of any stock without even visiting the factory or the plant. The next chapter talks about valuation. See, valuation is a vast subject and it's a very complicated subject. However, for your ease of understanding, I have presented the simplest ever method. You can conclude whether a company is overvalued or undervalued just by looking at 2 parameters. One is the PEG ratio and the second is comparing the valuation, comparing the historical valuation of the same company. So just by using these 2 parameters in majority of the cases, you can conclude that will help in your investing journey. How? For that you must have to purchase the book. The link of purchase from Amazon is available in the description of the video. This cost only $3.99. The Kindle version is also available at only $2.99. For you can also get the free Kindle version if you are a Kindle Unlimited subscriber. Along with this, in the valuation chapter, I have presented multiple myth buster. Like for example, value investing is not only investing in low PE stock. I have noticed many investors invest in low PE stocks like PE of 5, 6 and 10 and they call this the value investing. That's not. Many times these low PE stocks can be a value trap. Then secondly, I have also busted the myth that multiple times it might happen a 10 rupees stocks might be expensive than 1000 rupees stocks. So price is just a number. It's not just by looking at 10 or 15 or 5000 you can't conclude whether a stock is expensive or cheap. So in this chapter, all these details are there that you must need to follow for multiple insights in the stock market. The next chapter covers when to buy and when to sell a stock. I have mentioned multiple triggers which you need to look at to decide when to sell a stock and also when to buy a stock. Along with that, there are multiple myth busters, there are multiple do's and don'ts that should help a lot in the stock market. For example, I have noticed multiple investors attracted towards the stocks, those had fallen from say for 100 rupees to 50 rupees or those are trading at the 1-year low. So that can prove a very costly mistake. Don't think just because the stock price crashed from 100 rupees to 10 rupees, it must recover from 10 to 100. It's not. Rather, most of the time what happens if a stock crash from 100 rupees to 10 rupees, from 10 it can even further go down to 5, 4, 1, even the stock might even disappear. So don't think just because a stock price crashed by 50%, 80% or 90% it must recover. It's not like that. Also, no need to search, always search for the stocks those are traded at 1-year low or 2-year low. If a stock price is low for the 2 or 3 years, there must be some reason. So you must have to be aware of that. Along with that, there are multiple such insights which you must find very useful. The next chapter talks about do's and don'ts to avoid loss in the stock market. There are multiple do's and don'ts, like I am providing you some example. The first thing that I have mentioned, that never ever check daily stock price movement twice or thrice in a day. See, monitoring your investment is very much necessary, but monitoring investment doesn't necessarily mean just monitoring the stock price. Monitoring investment means you have to monitor the company specific news, the management interviews, sector specific news, quarterly result, annual reports and all. If you keep checking stock price twice, thrice or 4 times in a day, that will negatively affect your investment. In the book, I have mentioned in a detail that's how. And then I have also mentioned that never ever try to predict the market movement or the Sensex movement, how the market is going to behave. Never ever worry on that much. Remember, if the market moves up, it doesn't necessarily mean that all of your portfolio stocks should move up. Reversely, if the market goes down, it doesn't necessarily mean that all of your portfolio stocks will go down. So predicting the Sensex movement or predicting the Nifty movement is just a wastage of time. The next chapter talks about a very important concept, how to construct your portfolio. Here I talks about the little difference between diversification and over diversification. See, diversification is necessary, but if you are holding 50, 60 or 70 stocks, that's not diversification. Rather, that's over diversification that can negatively impact your portfolio. How? I have mentioned details in the book. Then I have mentioned about how you can protect your portfolio during market crash. So I have divided market crash into two parts. One is major market crash and another is minor market crash. So major market crash I can term only if the market or the Sensex corrects by more than 30%, and the remaining others are the minor kind of crash. So what you should do and what you shouldn't do during major market crash and minor market crash to protect your portfolio, I have given entire details. So you must need to read the book to find out the every details. Along with that, I have also mentioned a few set of stocks, a few criteria of stocks that you should avoid to avoid loss in the equity market investing. In the next chapter, you will find a quick formula which is very useful for you. The quick formula, with the help of this quick formula, using some parameters, you can filter out 15, 20 or even 30 stocks out of the universe of 5,000 stocks to shut down fundamentally strong companies to initiate the research. One have to remember one very important point is stock market is not a mathematics. Like in mathematics, a plus b whole square always have a particular outcome. But in stock market, that's not like. Here is no foolproof formula. However, in the quick formula, what I have mentioned is out of 5,000 stocks, you can easily shut down quality stocks, maybe 20, 30 quality stocks to initiate research. That will immensely help, because out of 5,000 stocks, maximum investors ask from where to start the research. So this quick formula will help a lot to initiate research and to figuring out fundamentally strong quality stocks. And next, I have mentioned another very important concept, that is a 2 minutes checkup. See, nowadays you will find stock recommendations are everywhere. You might find the recommendations in YouTube, in television channels, in Twitters. You will also find multiple news that the famous investors purchase these stocks and that. Now you must have to, whoever recommends, remember, whoever recommends the stock or from whoever you are getting the clue, be from YouTube or from television, anywhere. If after getting the recommendation, if you use just 2 minutes filter, if you can use the parameters what I have described in the book, you can easily figure out whether to avoid the stocks or not. I have mentioned just 3 or 4 criteria. So you must have to check using these 3 criteria for that particular stock. So if this criteria fulfills, then you can proceed with the stocks, and if this criteria is not fulfilling, then that can be a dangerous investment. So just by following this 2 minutes check after receiving any stock recommendation can help you a lot of your hard-earned money. So I must believe, so that would be a very useful feature, just a 2 minute checkup that can help you to avoid loss and in the stock market. The last chapter talks about little bit of myself. You can learn multiple things from my own investing journey, from multiple practical lessons, and also it covers the subject that money is not everything. Obviously, money is a very important aspect of all of our life, but that's not everything. So again, in the last chapter, you will find multiple insights that will not only help you in the stock market investing, but on multiple aspects of our daily life, be it in any profession. You will find multiple insights that will help you a lot in the last chapter. That completes the summarization of the book. If you are interested to avoid loss and earn consistently in the stock market, you must have to subscribe this channel at totally free of cost, because if you subscribe this channel, you will get the notifications of my upcoming insightful video. Without subscription, you won't get those videos. So if you didn't subscribe till yet, must subscribe, you won't repent. Also, if you have any kind of queries, make sure to put in your comment box, or you can share your feedback about the book on the comment section. For any queries, I'll personally address you. Also, if you find this video is useful, make sure to share with your friends, with the investing community, or in Facebook or in Twitter. That's all from my end as of today. Stay tuned with me, stay subscribed with this YouTube channel. I'll come with another interesting video on the upcoming days. Till then, happy investing.